Hey, I'm Walter. I'm your wealth educator. A little bit frustrated at some of the knuckleheads that post a lot of things on the internet about I'm such and such and I'm here to educate you so you don't have to pay 1% to your investment guy. So much more than that in terms of the story and the 1%. I'm going to show you something that's super interesting and super fascinating. It's called the Dalbar study, and it spans whatever decade you really measure. But this is equity returns over a particular period of time, whether it's 10 years or 20 years, of 8.5%. Now, I don't have the specific time frame, but the data is pretty universal in terms of the spread. So this is actually what the portfolio did during this period of time, but then the investor experience, okay, the investor experience, they didn't get 8.5, they got 3.5%. So this delta here, this gap here, is called behavior. So it's things that people do emotionally when they get freaked out, they make changes, they chase whatever is hot. This is 5%. This is a really, really big number. So one of the things that, again, I'm not here to tell you use an advisor or not, but when you measure the individual investor versus the investor that uses an advisor, even though they pay somewhere between 0.5% to 1%, they do better. And the reason that they do better is because they have a much more disciplined approach, and then they have a buffer between them and the sell trigger that helps them when they're in emotional crisis. And so this is emotional crisis. Think about crypto for a minute and the evolution of what's happened to crypto. I mean, crypto goes crazy up and then it goes crazy down. So how many people have had an ability to not worry about it? Or then how many people have traded it and missed out on really big gains? We've seen this year in and year out during crisis. You know, when do people sell and when do they buy? And so one of the other pieces to all of this is what they call the psychological effect of investing. And so when things are going up, we feel really good about it. And when things are feeling really bad, we want to sell. But it's actually the opposite of what you need to be doing. You need to be somewhat cautious when things are going up and up and up. And quite frankly, stock markets are making all-time highs, and there's just tremendous amount of optimism around AI and the build out of data centers and all that. And so we're sort of, we don't know if we're here or where we are on the way up. But the last 2 years, the stock market has been up 25%. Okay? And its long-term average is 10%. So what has to happen when you have returns well in excess of the mean? Only one of two things can happen. Either one, that long-term return is wrong, it's too low, or returns are going to be more mean reverting, meaning you're going to get returns below the 10%. And so this is why you see this cycle. But here is this maximum point of despair. That's when people sell. And so that's what contributes to this miss, that you don't even get the return that you are entitled to. So this mix is behavior. So one of the big things that I'll talk about in this video and future videos, how do you handle your fear? How do you handle your financial fear and your behavior to where you eliminate this? It's not about the 1% that you want to save and do it yourself. It's about getting control of your emotions so this goes away.